Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about building an income portfolio. So I started this process a couple years ago, and last week I covered tax efficiency of the different income products that I have in my portfolio for 2024. But now I'm going to expand on this idea and start talking about performance, allocation, and goals for this portfolio as we go into 2025. So analyze what we did last year and see where we go from here. So if that is what you're looking for, please stick around. So first of all, if you're interested in building an income portfolio yourself, I would want you to ask yourself the question of why? Why do I want this? What's my use case for this income right now? If you don't have a good use case, then I wouldn't receive the income in the first place. I would stay in more growth-oriented products, and that'll be more tax efficient because you're just receiving less. But if you decide to go this route, then the whole point of the video last week was to look for the most tax efficient products in 2024. So for me, I'm doing this as kind of an experiment, and it only represents about 15% of my overall portfolio. So I didn't bring that up last week, but I'm mostly exposed to index ETFs and some individual stocks. And I've got a whole video on it. I'll link it up above if you want to see what my main holdings are. I'll share that information. But this, out of these 30 or so ETFs that I covered last week, only represents about 15% of my overall holdings. I think that's important to understand. I'm in the early stages myself. I'm not in retirement, so I'm looking for tax efficient products. Kind of an interesting, fun way to invest. So what are my goals for this portfolio? Well, I'm looking for a nice combination of growth and income. I know, greedy. But on the income side, I'm thinking 6% or greater after tax distribution rate. As many people pointed out, it's not about how much you make, it's how much you keep. So I'm looking for those tax efficient products. That's the whole reason that I did video 1 last week. And then I would also like some growth. Not too greedy, but some growth. Over the long term, I want to see growth within the portfolio beyond the 6% that I'm receiving. I don't think that's too much to ask for. I also want to keep expenses low. And I know I harp on this point quite a bit. We have a lot of discussions about this, but expenses can really eat into your overall return, and I don't think people give it enough credit. So I'm looking for 30 basis points or less. So when you start talking about an index like VOO, the S&P 500, that's 0.03% or 3 basis points. So I'm giving myself a lot of leeway, 10 times that, 30 basis points. So let's jump into my spreadsheet now and take a look and see how we did back in 2024. We're going to take a look at performance, allocation, and we're going to see if we met any of my the goals that I just talked about. We'll see how we did. And based on this information and all that tax information that we have, we're going to make adjustments to this portfolio going forward. I'll show you what I'm going to do as well, or what the game plan is going forward. Now, all this information that you do see here is from Seeking Alpha. I'm a Seeking Alpha affiliate. I know I often mention it, but it is a great way to do stock and ETF research, especially when it comes to these alternative investments. So if you're looking for a discount, that's down below. Check it out. Hopefully this is large enough to see on your screen, and I will try and put a link to it down in the description as well. But this is the same spreadsheet as last week. I just expanded on it. So all this tax information in the front here was covered in the last video, which I will link above and below. But to make it easier to gather all this information, I did make an assumption. I assumed that I owned these positions for the full year. But in reality, I was adding them during the year and also adding to them during the year as well, building up some positions. So I really just wanted to see how it performed for 2024. And I'm also a fan of nicknames, so I'm going with the Evolving Income Portfolio. I know, what a name. So I guess first question, do you have a nickname?
Guess what they used to call me in high school?
Cinnamon Muff.
No, they didn't call me Cinnamon Muff.
What do they call you? Firecrotch.
Also, the returns that show in gray, for example, right here, are for products that were not around for the full year. So I used the partial year return. Again, this made it easier just to pull information together, but it should get us close to the overall return for this portfolio. I know I assumed taxes to be pretty high. A couple people brought that up, and in my mind, this is a worst case scenario. This will typically be lower for most people, but I will keep them the same as last week for consistency. Again, from that download, you can adjust these if it's more appropriate for you to be a little bit lower, and you know that for a fact. And then we got the distribution rate also. This is right here. This is our trailing 12-month TTM distribution as of March 5th. So again, this is March 5th, 2024, and the grade areas are again based upon a partial year. So I extrapolated out what has been paid so far and set it for a full year. So now let's jump in and take a look at the guts of this portfolio when it comes to allocation, distribution rate, expense ratios, all that kind of information, and see how we did for the goals that I set for this portfolio. So we're going to start right here, 2024 price return. So this is the price return for every one of these products going back and looking for the full year in 2024, except again for the grayed out areas. So you can see we have good performance from some, like over 10% for iSpy, over 13% for JEPQ, same thing, over 13% for Bally, over 34% for Maine. It performed very well last year. This is going to be our benchmark, right? The S&P 500 over 24% in 2024. So that's what we're going to be comparing this to overall. That's what we should always be striving for. But there's give and take when we're talking about an income portfolio. So I do get that. We also have VYM, which is just a Vanguard high dividend yield ETF, and some other products down here too that did pretty well. For example, QDPL and GPIQ. Whereas on the other end, VTEB, which is just a Vanguard tax exempt bond ETF, did not perform very well. Along with that one, we have things like SVOL, which had a negative 9% price return. Again, we're just talking about price return, which will be offset by the fact that this distributes quite a bit of income at 17.45%. So overall positive return, but it did give up quite a bit on the price return side. So combining these two together gives us our total return. So that's our price return, and you're going to see some negatives, you're going to see some positives. Then we can jump over to the distribution rate. The 2024 distribution rate, this is the rate right off of Seeking Alpha that I could see for TTM going back to last year. The grade ones are assumed again. So you can see we've got some that are pretty darn high, the highest one being FEPI, all the way down to some really low ones, which are kind of those base ETFs like the S&P 500 at 1.26%. So that's our 2024 distribution rate for these products. And since this is a taxable account, it's important that I take a look at the after-tax distribution rate. So based upon my assumptions here, these different tax rates, I get my estimated overall tax rate for each one of these products, and that can provide this information. So what do I actually get to keep from this distribution rate? So yes, it's distributing 5.96, but I only get to keep 3.87. That's what that means. Here's my 2024% allocation for each of these products at the end of the year. Of course, this is kind of a living, breathing thing that's going on. I'm adding to this throughout the year, but I had to pick a point. So I picked the end of the year, and that was my allocation. A couple of them that I eliminated throughout the year I set to 0, and those would be things like BKLN and HIGH. Whereas a couple of these are my larger holdings would be things like, let's see, this is JEPQ at the end of the year. I have made adjustments to these. IWMI, I added a decent size holding there towards the end of the year, and SPYI. Again, so some assumptions within this portfolio. That's my allocation. And the next to that is expense ratio. I'm always keeping my eye on that. So those are the expenses for each one of these products. Now we can get into my final calculations, which are my cont. That's not a bad word. These are contributions from these different areas: price return, pre-tax distribution rate, after-tax distribution rate, and expense ratio. The contribution from each of these funds. So let's start with price return. This is just math, but then the bottom here is the important thing. So this is giving me a 6.53% price return for 2024 based upon the allocation and the other assumptions that we've made here. So not bad, but when you think about it versus our benchmark, which is the S&P 500, we're well behind, right? We're really lagging here. So that's some of the sacrifice that you're going to have, especially in a really positive year like we had in 2024. When the S&P 500 is up that much, this is what this looked like with this fund allocation. Now, a couple of things, I guess, is one, I've got about 11.5% set with bonds and cash. So that's going to drag it down a little bit. But we still always want to compare to simple, easy investing. And this is an impressive number. But what would it be like in 2025 if we do have a big drawdown? Let's say the S&P loses 10%. I would imagine I won't lose that much based upon some of the product makeup here. It could still happen. I could lose even more. But I don't think I'd have that drag in a negative year. So that's kind of the give and take, right? So, and we would typically say that's the beta of our portfolio. We're not going to follow the market as much. We might outperform in a negative year. Next up, pre-tax distribution rate overall gives you 9.14%, and after tax, looking at 7.71%. So that's well above what I stated as my goal, which was 6% or greater. So this is where I'm going to start making adjustments going forward, maybe giving up a little bit of this so I can still hit my goal, but try to find some more growth. So overall, 6.53% plus the 9% was my total return. But if you factor in taxes, that drops my distribution rate down to 7.71%. So what do you think? And then expense ratio, because I mentioned this, I wanted to target under 30 basis points. I'm at 0.38 or 38 basis points. So not quite hitting my target there. So that's something else that I will consider, and I'll continue to review products and hopefully find some ways to cut into that expense ratio as well. So let's think about that a little bit more versus our benchmark. If I slide down here, you can see my effective tax rate is around 15.66%. So overall, I'm paying 15.66% for all these distributions that are coming out to me based, again, upon these assumptions. So that's not terrible, but I think it's something that I can improve upon. And if you think about like VOO, I'm saying that's around 17.12% based upon those higher estimated tax rates. So we're kind of in line with it, depending on how we set this up and our assumptions that we make. So if you were to own VOO only and sell shares, you'd be in that long-term capital gains tax rate, along with that's where this would fall as well. The distribution rate at 1.26% fall into that same category. So we're right around there, but I would like to see that improve. I'd like to drop that even more. I would want to separate myself from this and be more tax efficient. So that's certainly a goal going forward. Effective expense ratio, kind of talked about that a little bit over where I'd want to be. And no, this isn't bad math. It actually is the same. Estimated total return, 6.53. I think I can double click that, showing you. Yeah, that's the addition of those two together. Again, not taking into taxes into account, but essentially saying this is giving you 15.66 estimated total return. And again, versus our benchmark, which is 24.15 plus the 1.26 would be the equivalent, right? So well underneath, about 10% underneath. So something to consider. So game plan going forward. How will I change this in 2025? Well, I already sold HIGH. I mentioned that. I sold that early 2024. I recently sold SVOL, but I do still own some in a retirement account. I think it'll just function better there, especially when you consider how high the estimated overall tax rate is for this product in a taxable account. I also sold FEPI, which did pretty well overall. Like it gave up 9% from a price return perspective, but it did distribute almost 30%. So it had a nice year overall. I sold this toward the end of February. It performed well in 2024, but I expect less in 2025. So I'm moving those funds into some other positions. I lightened up this week on JEPI and JEPQ. Why?
Of course it's their fault. They're the two biggest dickheads in the world, and they're living in your house. Garrett.
I can't have these in my house. Actually, these two have performed well. The expense ratio is reasonable for these products, and I think they're solid funds. I'm still keeping about 30% of my original position, but I'm slowly reinvesting what I did sell into some others that I hope will be more tax efficient for my portfolio in this taxable account. The funds I sold will mainly go back into GPIX, GPIQ, SPYI, QQQI, somewhere down here, IWMI, so a lot of these NEOS products, I think I'm going to try to put a little bit more there. And then T-SPY, which is something I started buying at the end of 2024. We'll see how that one progresses. And I will maintain my balance of around 10 to 15% in bonds and bond funds as well. That provides me some ammunition. If there is a significant pullback, I can roll out of those and I can go heavier into the market. And also, as I buy some of these covered call funds, I'll also be investing in some of the underlying assets that go with these. So for SPYI, I'll go out and I'll buy some VOO, or just the straight S&P 500. And this has the impact of reducing my expense ratio overall, so I can hit that target. It does provide a little bit more growth long term, which is attractive to me. And while it does cut into my distribution rate, I have some room to play there. So I'm looking to balance that out. And that can happen by buying some of the underlying assets. So VOO, VIOO to go along with the Russell, and probably something like QQQ or an equivalent when it comes to the NASDAQ. So all these changes will drop my overall distribution rate, but I'm hoping this gives me better tax efficiency in 2025 to offset that loss. So with a lower overall tax rate, my after-tax distribution rate should still stay above my 6% target rate. Now, one question I did get from last week's video was about return of capital and how that could vary from year to year. My statement was this could change quite a bit one year to the next, and the question was why. And a simple example might be SPYI or one of these other covered call funds. So in 2024, we saw nice big gains in the underlying stocks within SPYI. But the options themselves probably were not that profitable. Again, they're selling out of the money covered calls. They sell it for this much, and they have to buy to close. And if we had a nice big gain in those underlying stocks, you might close that for a loss, right? And this will give them distributable income that would qualify as return of capital. But in a year, let's say 2025 is completely flat. The S&P 500 is just flat. All those underlying stocks are flat. Every month, though, they're selling these out-of-the-money covered calls, and they're collecting that income. So they sell it out of the money, they close it, or they roll it, and it's pretty much free. And that's just income that they're collecting. They won't be able to distribute that as ROC. It will more likely come out as ordinary income. There might be some accounting measures that they can do to twist things up a little bit from one year to the next and rolling some of this from one year to the next. But in general, it's going to be difficult to maintain this 94%. And some of that will shift over here to ordinary income. So in summary, the portfolio did okay. It did meet some of my goals and objectives that I set. And it'll be interesting to see how 2025 it performs as I refine what's in there. When I start looking closer at the taxes and I start changing around the allocation a little bit to meet my objectives, how will I feel? So in 2025, let's say we have a down year and the S&P 500 drops 10%. Maybe this portfolio only gives up 5% and it gives me that income as well, so I feel pretty good about it. And that allows me to make adjustments as I go through this too. Because if I look at 2024 results, I'm not that happy when I look at it compared to the S&P 500, where simple, easy investing, just buying the S&P 500, smoked it by about 10%, right? So where do you want to be? How do you want to invest? I still focus mainly on that growth idea, and it's been working out. But I'm slowly building this because as I get older, closer to retirement, this idea of being able to peel off 6% after tax and maybe still have some growth is pretty appealing. So I'm going to continue with this idea and continue to refine this portfolio going forward. So any questions on any of this, please ask down below. Like and subscribe if you like this type of idea and this stuff. And we'll see you next time. Have a great night. Boop.